That's some great stuff. All right, it's February 15th. Happy Valentine's Day to everybody. Welcome to the weekly meeting. Uh, Halfway through February, short month, but it is still plenty of opportunity. And the thing that I hope people recognize or understand is how well and how fluid the market has been moving, right? Um, and I know, most people probably don't pick up on it, but when we come out of December and we get that January candle, many of these pairs are changing directions, or they're going, they're headed to wherever they're headed for the next 6 months, or the next 5 months, if they get there fast and then they consolidate. So generally speaking, you're gonna get bigger moves in the beginning of the year, and you'll get these shorter moves or the range bound moves uh, over the summer months. And you'll especially notice that in a lot of your indices. But your pairs, you can see it as well. And those of you who trade the higher time frames, or look at the higher time frame, the candles, the 3 months, the 6 months, you'll see that those trades move. So you're going to get a lot of pips on your weekly moves on these early months. So it's great if you can take the opportunity, or take care of your account while you're getting these longer moves, because um, if you're on the wrong side of that move, then you'll get wrecked. But if you start off on the wrong side and you course correct, then you can make it up. I know the last couple of weeks, the pip count has been pretty extreme, like 500 pips, 600 pips, uh, and it's not something that is foreign, I guess, but it's something that we can take advantage of if we understand um, like what's available to us, and why it's available to us. The market is moving towards its destination. And if you did your analysis, at the close of January, I mean, close of December, then you kind of you saw it coming, right? Uh, we kind of understood that the dollar was going to get weaker. We understood that the JPYs would get weaker. Fundamentally, that was in the air. Now we did have some hiccup, with some of the policies that the new president has enacted or threatened. But I think now the dollar, especially in the last couple of weeks, the dollar has started moving to the downside. Um, so I think that it would behoove us to trade with it. There used to be a saying that don't fight the Fed. Well, if the dollar's moving down, then we're going to make more money if we trade with with the dollar as it moves down, and we trade with the other instruments, whatever direction they're trading. All right, this what I want to kind of share is this video, uh or a piece of this video from the mentorship episode 17. I know I don't really talk about these later slides, but they're all important, and they're all kind of hit on the same or similar situations. And we had a situation with the JPYs that was very similar to this setup. Um, but he kind of explains his thought process, on the setup. Where, if you look at this chart, price went up and attacked these relative equal highs, and then it turned to head down, right, and to attack the lows that he has marked out. And a couple of weeks ago, the JPYs were in a similar situation where you're kind of sitting in between. Price goes up, and it pulls down to attack the lows, right? We attacked this low, we attacked this low, and now price has pulled back. Um, so if you're a person who's not accustomed to looking at higher time frames, or like kind of getting your guidance from the higher time frame and kind of understanding what's going on in the higher time frame, it's easier to get caught up in one direction or the other. Sometimes it's better when price reaches a level to get the heck out and wait, right? Because it's pretty easy to get induced on these moves. We had a 500 and some pip drop and a 500 and some pip pullback. And price was in the relative same situation or same area that we were before we ran these lows, right? So the problem with trading after you run highs or lows is you're not clear many times on, hey, are we pulling back or are we going to continue to the next high or the next low? And I'd be lying to you if I said, hey, man, I know exactly what we're doing. You know, I'm just like everybody else. I have to wait for guidance. You know, I need to pay attention to structure to see which direction we're going. If I'm just looking at this chart, um, what I like about the chart is we held short of this high. But what I don't like about the chart is the short range of the candles. So all we're really doing, we're consolidating out, right? Now, if we look at the consolidation, I can make an assumption that we're at least going to pull down to this imbalance. But that doesn't mean we're going to break this level and continue to go lower. So me as a trader, I'm not going to trade this. And I get it. You know, if you want a 100 pip trade, you know, and you trade it from this area down, that's cool. Or you get in Monday and you just trading down here to get your 100 pips. I got it. But I think for the most part, you know, the people who have been trading the JPYs, you're not getting out at 100 pips because it's been giving you 5. It's been giving you 3. It's been giving, you know what I'm saying? So you're fooling yourself. So for me, I'm not messing with it. Like there are cuter trade setups, you know, and cuter and drunker trade setups that's going to give me my money without resistance. So we have to kind of understand and recognize when we should proceed with caution, right? Well, we should, or if you're going to trade it, you got to trade it with respect. Hey, man, you know, I see the trend line liquidity, I see the imbalance. We're bearish, so I can trade it to this low, and then I have to take a wait and see approach. But I don't want to keep, you know, taking all the information. I want you to kind of hear the thought process of the OG, you know, when he's talking about these similar setups.
Open or close is here. So I left the highlighted candles so you can match that up on yours. And then we have this old low. So below this old low, if it goes below that, how many pips can it go below that? Well, we have the big figure 109, right?
Let me back it up a little bit. So,
right. So we're going to drop down to an hourly chart.
So Terry can hear what he's saying.
The relative equal lows, relative equal highs, highlighted. Your buy stops would be resting above here, and the market will go just above that a little bit. And then once those buy stops are taken for anyone that's short, they're getting knocked down in a loss. And that flood of orders to be buying at the market is counterparty to individuals that want to sell short. So smart money is selling short up here with the expectation it's going to go below this low here, and potentially below that low down there. So today's trading, we had the open. It rallies up a little bit, then careens through the short-term low here and below the relative equal lows here. Not by much. We'll see it, but it's still there. Now, what level on the downside after this day closed, if we're looking for lower prices, what could we expect it to draw to? Obviously below here and below here, but what price level? 109 big figure. So the big figure numbers, okay, or the zero levels, they're very influential because there's lots of liquidity that is used around those levels. A lot of commerce, a lot of business transactions that come in just for the sake of simplicity. 0 level, the 20 levels, the 50 levels, and the 80 levels. So I dub them institutional price levels. I teach that in the free videos in this YouTube channel too. All right, so we're going to drop down to an hourly chart, but before we get into that, I'm going to revisit the swing trading idea that I taught. Highest up close or opening in this retracement up, and the lowest open or close is here. So I left the highlighted candles so you can match that up on yours. And then we have this old low. So below this old low, if it goes below that, how many pips can it go below that? Well, we have the big figure 109, right? Remember the previous chart here? Watch. Over here, that's essentially the 1.09 big figure. So do we have any levels in here on the fib that correspond to that? Well, we have 1.0919. That's possible. Then we have 1.09101. That's another level that's possible. And we have 1.09011. Essentially almost the big figure, right? So we have a standard deviation from this swing to here. If this is broken, these are only true if this low is broken. Okay. So this is a fulcrum point, and this is a fulcrum point. So how do we know which level we're going to aim for? Well, we have those relative equal lows at the 109 big figure level. And then we have our fib calling for these levels down here. And the lowest one, without going through 1.09, is this one here. All right, on the hourly chart with our buy side liquidity pool level here, the market trades up into that area, absorbing all of that liquidity, then breaking down, takes out a short-term low here, and here, and here, retraces up in, breaks lower. Then we go into today's trading, the 5th. Prior to today starting, we know that it's likely to draw below here and then down to that 109 big figure. You have a lot of convergence around that 109 big figure. At the beginning of the day at midnight, New York local time, that's going to be right in here. If we see the market rally up, which is what we want to see a protraction in the marketplace where it starts to go against the expected direction of the move intraday. So if we're bearish and we're looking for that 109 level to be traded to and attack the liquidity below here, preferably we want to see it rally first. That's the Judas swing. Okay, that market protraction is what we're looking for manipulation, part of my concept Power 3, which is accumulation, manipulation, distribution. Okay, so once the day begins at midnight, we're anticipating a move up. What's it going to be trading up into? This imbalance in here. Okay, so once it does that, it kind of like forms the daily high. And then the rest of the day, you're going to be looking for distribution throughout the day, looking for lower prices.
Okay, I want to kind of, he's talking about an intraday move, but I want you to think about this on any time frame, on the weekly, on the monthly. It's all the same. It's fractal. So if you're bearish for the week, you want to see the market go up first, right? Preferably trade into some imbalance or some, right above some old highs to take liquidity. And then you want to see the market distribute lower, towards a imbalance, towards relative equal lows or something later on that week. So I know he's talking about an intraday move, but you think about it on the level that you trade on. If you're if you trade that weekly candle like me, think about it like that. If you trade the monthly move that we trade many times, think about it like that. If we have a bearish order block for a month, we expect the price to buy up. We want to see it go down first to take out the low of that bearish order block and then buy into the imbalance of that order block. So just think about it in those terms. I know he's talking about an intraday move, but it's all relative.
So inside that little shaded area, we're going to use that going forward. So let's drop down into a lower time frame. 15-minute time frame. here is that imbalance. That doesn't look that clean on a 15-minute time frame, but the hourly is what we're framing it on. Okay. So the market trades up into that. Here is the midnight New York local time candle on the 15-minute time frame chart. Opening price is here. Extend it out throughout the day. That is your midnight New York candle opening price. Preferably, if we're selling short, we want to see price trade above this opening price. This is where smart money is accumulating short positions. See that? So the algorithm goes higher, once more higher, once more higher, and then again right here, and then begins its descent into the daily range low. Now, what's occurring here? This is not buying and selling pressure. The algorithm is offering constantly price above this opening price. Now, every single time it rallies up, just because it does that doesn't necessarily mean that's a time for you to get in. But when you couple that with time of day and price, it becomes a lot better. Notice we have an imbalance in here. So the fair value gap there and price runs up during the New York open kill zone. Okay, so I dubbed this specific time of day between 7 o'clock in the morning New York time to 10 o'clock in the morning. This is specific to Forex. Okay, these times are specific to FX pairs. If you're going to trade an index, don't worry about that. You can work with the 8:30 to 11 o'clock New York local time. But for Forex, the algorithm is going to operate on these specific elements of time. So if we're looking at this imbalance here, the market runs up and it overshoots the imbalance a little bit, but what's it really go to? The last up close candle, which is a bearish order block. How do we know it's a bearish order block? Because we have the imbalance here and it's trading back up into after a nice move lower. So this displacement, fair value gap, last up close candle, touches it, there's your bearish order block. Dropping down into a 5-minute chart, everything being as it was on the 15, that's that order block here, just being shown on a 5-minute chart. But I'm adding now the annotation of the New York open kill zone. 7 o'clock in the morning begins here at the end of that line segment, and 10 o'clock is here. So everything underneath this end of the trend line here and below this part of it, this all is during the New York open kill zone. So you're hunting your setup for Forex pairs within that little block of time. So during this time, you're hunting your setup. What price are you looking for? Preferably at or just above the opening price at midnight. Now, if you are a New York session trader, you want to refer to the opening price at midnight, but then you want to recalibrate at 8:30. And we'll look at that in a moment. But for now, just notice, looking at this particular day on the economic calendar, we had a high impact news driver at 10 o'clock in the morning. It was the ISM Services PMI number. Now, before you want to start sending me emails or start sending me essay questions in the comment section of this video about what does the ISM PMI number do, I don't care what these numbers are really discussing. I don't care. I don't care about the raw data. I don't care what the expectation is. I don't care. Okay. What I'm expecting is the volatility in the marketplace at or around these specific times, because the algorithm is going to use that injection of volatility to facilitate trades. Now, is it trying to give you good trades? No. It's trying to move and rebook and reprice to levels to allow those in the know to participate. It's a rigged game. You're not supposed to be in it. Not consistently profitable, let's say it that way. But for those that are in the know, they're looking for these types of signatures and price action. So they know what they're looking for in terms of when they're going to operate. So as a technician, they're looking for a specific element of time, which is encapsulated with this segment right here, 7 o'clock to 10 o'clock. So that little bracket of time right there on a 5-minute chart, you're hunting your setup. What is the thresholds that make it high probability? Well, if you're going short or looking to go short, you want to be above the midnight opening price. That's here. extend it out in time. But now once we hit this order block here, that was during the early stages of the New York Open, right around the 7 o'clock hour. The market drops and then retraces back into that news driver here at 10. So what's happening here is look closely with this swing low. It went below this low here, and then it rallied back up once more above the opening price at midnight. Does it take out this high? No. Why doesn't it take out this high? Because it has an imbalance here. That imbalance tells you this is an intermediate term high. If we're bearish, it shouldn't take this high out. Now, again, I mentioned this in a recent video. I think, if I'm not mistaken, it was episode 12. I'm going by memory, so please don't roast me in the comment section if that's the wrong one, but it's basically what I'm talking about: intermediate term and short term and long term highs and lows, or swing highs and lows. An imbalance or a fair value gap associated with a swing high or swing low. In this case, this is an intermediate term high, not because it just simply has an imbalance, but because the narrative is we're expecting lower prices, and it went above the opening price at midnight. And the imbalance there, when it retraces back up into this fake run ahead of the news driver at 10 o'clock, the news, if you will, this movement here is only running right back up into the bearish order block. Last up close candle, the body. I don't like to use these long tails and wicks. I'll refer to them, but I like to prefer to annotate if I'm going to show it in my examples, or look to price returning back to the body of the candle. Right there. So this return into that order block sets the stage for another move lower. We get a swing high, lower high to the right of this candle, and a lower high to the left of it here. So we have 3 candles making a swing high. So we start looking for displacement and movement lower. But looking closer, after we had that shift in market structure here on a 5-minute chart, it retraces back up, fair value gap, bearish order block, and news. This is the wild card. Okay, when you have high impact news drivers, this is going to many times scare you out of the trade or stop you out. In other words, if you went short back here and you start trailing your stop loss, this is what that's designed to do: take you out. So if you're short back here or here or here, how are you protecting the trade? You're putting a buy stop above recent swing highs. So they're jamming it up against that, back above the opening price, because your buy stop is going to flood the market with buyers willing to pay at a higher price than it was here before it runs higher. And you're going to buy, or those individuals that had their stops, they're going to buy the counterparty side of the smart money that wants to sell short. Because every buyer has to have a seller, every seller has to have a buyer. So that's what's occurring here. But inside this shaded area, I'm going to show you how this model is applicable here in FX. So here's the 4-minute chart. We were just looking at 5. So we start stripping down this price leg here, and we're looking for any fair value gap. Do you see it? Pause the video, look for it.
Some of you don't pause.
All right, I'm about to show you. This candle's low, this candle's high, there's your fair value gap. Isn't it interesting how this goes right up into there, closes that in, then and only then the market starts to aggressively run below the short-term low here, and then reaching into our objective down here at that 109 big figure. Now, it doesn't quite get to 1.09 even, but it does get to our Fibonacci extension for the standard deviation. It does get down to the old relative equal lows on the daily chart, which is what that blue line is. And look at the bodies respecting that level. Not much movement below it. Now, for all of you raw dogs out there, okay, this is too much, Michael. You're overcomplicating it. You're confusing me, Michael. You're talking about the midnight candle for the opening price, and now you're talking about the 8:30. Which one do I use? Why do I use it? This, that, and that. All right. If you're going to be trading FX, you're going to be using the 8:30 in the morning for New York session trades. But refer to the New York Open at midnight as well. If the opening price is lower at the 8:30 than that of the opening price at midnight, use the lower one. Reason why is you want to set the minimum threshold for a Judas swing or a market protraction to the upside when you're bearish. And obviously, everything that I just said would be reversed if you're bullish. You'd be looking for a move below the opening at 8:30 to go long after it moves below it. But we're focusing primarily on the shorting opportunity here in hindsight, so that way you can get a better feel for how to use this model with FX. So there's a subtle little group of nuances that you have to be aware of when you're looking at FX, but it's not terribly, harsh. It's pretty easy to work with. So we have the market trading above the opening price here. Market protraction due to swing. It rallies up and then breaks down in here. Now, this run here above the opening price, does it have a fair value gap? Here's the 4-minute chart. Opening price now doesn't look the same because we're looking at a 4-minute chart. So it was anchored on a 5-minute chart. It rallies up. It break lower. Fair value gap right there. Trades up into it. Hammers it beautifully. And the displacement trades lower down into that 109. What was it? 1.0901 something or other. I can't remember off the top of my head. But it hit it. And I think the low of the day was 1.0901. So not bad. I mean, it's pretty close to perfect, right? But by itself, you don't want to try to aim for just that level, okay? Because that's the best exit strategy. You don't want to do that. You want to fluff up your exits with a couple pips. And I like to teach my students 3 to 5 pips. And if you're thinking a target is going to be, like, for instance, we'll say 1.0900 level. Okay, if that's what you think it's going to trade to, put your limit order to cover your shorts if you're short at 1.0905. Okay, you're not going to get the best exit that way, but you have a spread that you have to incorporate when you're working with Forex and FX pairs. Sometimes, and I've had a lot of this happen over the years as a FX trader, where my limit order was a little too overzealous. I was trying to be a little too perfect, and I've had many amazing exits elude me because of my overzealous targeting. So be a little bit more forgiving when you're trading, especially Forex. You got to incorporate the spread. And I know some of you have brokers where it's like, oh, I have a really tight spread. Let me tell you something. Every broker has the ability to open that spread up on you. You're seeing the best case scenario when that ticker is showing. But trust me, when it's advantageous for them, they'll work it in their behalf, not yours. So make it easier for yourself. Just fluff up your exits with 5 pips. Okay. And if you're really new, just use 10 pips. Okay. And if you're struggling with the idea that, oh, I don't want to do that, I'll give up 10 pips. Well, let me show you this. This would be your entry candle, trading right back to this old high here. So 1 pip add or thereabouts. Once it hits that candle with this run here, that right there would be your entry candle. Your stop would be right above this candle's high. Now, if you're scared or whatever, you can use this swing high and that's fine. Now, in terms of math, the entry price would be 1.09653 and your stop would be 1.09728 hypothetically. That's not a lot of pips. I would generally round that to 10. Even though it's not technically 10 pips here, I would round it to 10 and just be done with it. And looking at that model here, and you're aiming for that essentially the 1.09 big figure, fluffing it up a little bit so our exit price would be a little bit higher than that. You guys see these things all the time, and I just felt like using it, just because I want to be cool. The risk is here. Entry to stop, and the distribution to your target down here. Risk to reward ratio better than 8 to 1, and using a hypothetical $100,000 demo account if you're doing one of those 100 account challenges or whatever. In this trade here, this gives you basically what you're looking for in one trade. So I don't know.
Okay, so hopefully you guys are following along. I get a lot of questions about entries. Notice how when he identified the fair value gap that he was interested in, right? Um, he knew that he wanted to enter the trade at that gap. So when price ran up into that gap, he didn't say I had a limit order set. He didn't say he took a market order. He didn't say he put a sell stop. He's leaving that up to you. As a trader, you one of the things that you're required to do is make decisions. So it is up to you how you enter the trade. He's merely pointing out to you that that gap represented your entry. That's where you should have been looking to enter the trade. Some things are your responsibility. For you to understand, hey, I need to be ready to enter the trade here at this level. I need to see X, Y, and Z. You have to have that in your toolkit as a trader. And then even if you would use a limit order right here, you'd have been fine. If you had used a market entry, you'd have been fine. If you had waited to see price coming here and you use the sell stop order down here, you're fine. All those are ways to enter the trade, but you have to make that determination. Y'all tracking?
If this scratches the issue,
Yep. All right, Myron Golden.
it works in index trading. So it's a matter of adjusting to what it is you're trying to trade. And then there's a little bit of rule following that you have to know when it comes to index trading and FX. FX, predominantly, you're working with 7 o'clock in the morning to 10 o'clock in the morning. That's your New York open kill zone. Okay. Index trading, I'm focusing on 8:30 to 11. And I can take a trade all the way up to 10:40, 10:45 and still be okay. I'm not interested in taking new trades generally after 10 o'clock in the morning in the FX pair, unless there is a news driver like we had this morning with the ISM number, the PMI number I mentioned earlier in the video. So that was allowing me to be a little bit more forgiving with expectations for price. You may not want to trade high impact news drivers, and that's understandable if you don't know what you're doing, but don't be afraid of them. Now, with the economic counter having that high impact news driver at 10 o'clock, that extends the New York session kill zone into the 11:30 time window because the volatility that it will bring in. Now, I didn't take this trade. I haven't taken any FX pair trades at all. Not for 2022 at least. But if you're looking at a model that works in index futures, you're looking at that 8:30 to 11 o'clock window. And if you're trying to apply this model to FX, it's 7 o'clock in the morning to 10 o'clock in the morning. Now, the high impact news drivers that come out after 10 o'clock, like for instance, if you're a Canadian dollar trader and the crude oil inventory number comes out, usually like 10:30 in the morning, you have to make allowances for that and just expect there to be a likely move on that oil number at 10:30. So just something to throw out there. I know a lot of you have been barking, wanting to see something.
Okay. Y'all heard it from the man. Not from me, but from the man. So do you guys have any questions first of all?
Yeah, I have a question real quick, Todd. So when he's talked about the midnight, the open of the midnight candle,
Mm-hmm.
and because I've actually been incorporating this now more in my when I'm looking for my setups.
Okay.
Does it have to go above just the midnight and the New York, kind of what he's saying, or are you only looking for just that midnight situation? And the reason I'm asking that is when they had that first rally in that video, then you had that Judas swing up. What would constitute? Why wouldn't somebody look at that first rally up versus waiting for that Judas swing to go up from that open?
Well, okay. Are you an intraday trader?
I can see intraday. I like to intraday trade.
Okay. So let's talk about that in turn. Let's look at this GJ trade set.
Okay.
So, in fact, let me go to the 1 hour chart because this is very similar, right? Of course, this move started on London session. If you notice, let me put my Asian range back on. You can see the Asian highs. If you're a London session trader, we use the highs and lows of the Asian range all the time, kind of the same way that a New York trader would use the midnight open, from what ICT is saying.
Okay.
It goes above, we get our run down. So all throughout this, while this trade is consolidating, there's going to be entries for whatever session you're on, right? So this push down, notice how this push down runs right into what? The New York Open, right? So what is your bias for this trade at this point? If you're looking at this like most people was looking for, like this was a sell and it was just going to keep going, you're looking for a pullback to get in for a short, right?
Mm-hmm.
So it gives you everything you want. This is the 7 a.m. candle. This was the actual candle you should have got in for the buy if you were looking for the pullback into this area, right? But some people skip steps, and this flush of the market right here was, I think it was over 100 pips. And what happens when you get a flush like that, people get big eyes, they get hungry, they get greedy, they get that FOMO. So they want to get in for the sale. Even though price runs into this order block down here and you get the bounce, this pullback right here is what's going to give people their entry for New York session. And they're going to get in to go short. And price is going to come down and they're going to do the rug pull. And now you're caught into a consolidation. And you're going to have to either extend your stop loss, or you're going to take this loss, or you're going to be in a hedge. Because you didn't wait for price to come into the imbalance of this order block here. But my point is, it doesn't matter where you enter the trade if you enter above that open price. For instance, if you enter here, this consolidation doesn't matter. In that video, the consolidation never went above that original high, right?
Mm-hmm.
And he made sure he mentioned a term called an intermediate high.
Mm-hmm.
If you're in the move, you get in the move when you're supposed to, it doesn't matter if the trade comes back, it keeps coming back. Because the algorithm, from the way he teaches, the algorithm is going to deliver price. You're not in control of the time that it delivers price. What people didn't know in that video prior to that, while that trade was moving, was the algorithm was just hanging out until the news release to move to have that influx of volatility to actually move the price.
Mm-hmm.
And when we trade, a lot of times we get caught in moves. Many times when you trade these as a swing trader, you're going to get in a move like this, and it's going to go sideways, and you're gonna be like, God, no, right? This is, if you're not built for this, this is why people get out of the trade. Oh man, this trade is bullcrap. I've been in this trade for 2 days. Yeah, but we have to think. This was February the 4th, 500 pips. February the 11th, 500 pips. Bruh, like this is 1,000 pip delivery within the month. But you want to get in this trade and get another 500 pips in a short month. It doesn't always work like that. Like the algorithm is controlling the price. So maybe you can't move 3,000 pips in a month or 1,500 pips in a month. Maybe it's going to take a little time, but if you enter the trade at the proper spot, then it doesn't matter how long you sit in the trade. You're either, I mean, it's either you got a good entry and it's going to where you think it's going. And what I would say is these imbalances, right? Probably this low is a good target because there's an imbalance below it. But in my opinion, you're not necessarily guaranteed anything below that because price is in between this high and this low, and it has to make a decision. I'm overall bearish for this pair, and I know we have another low down here that we need to tackle. But in this particular trade, we've knocked out two lows in the last week. We knocked out these lows, and we pulled back. We didn't break that high. So this is the swing, and here's your swing.
Mm-hmm.
If you're entering here, which is where you should enter if you're short, you still have to respect the imbalance and respect the fact that this could very well pull back to go higher. So if I'm trading this, which I'm not, I know a couple of y'all are, but if I'm trading this, I'm fibbing this move, I'm looking at my zone, and I'm out of this. I'm getting out. I'm taking my price at the 50. I'm getting out because I don't know where it's going. I don't have the advantage, guys. Like you don't have the advantage. I know that we got caught up in the JPY. The JPYs moved beautifully, but in my opinion, you got about 177 pips to feel safe because after that, we don't know. We don't know if we're pulling back up here to the 78 because that's where the whole move came from, or we don't know if we're pushing lower. So I don't have time to give back any of the money I made in both of these moves. So get in the trade when you're supposed to get in the trade. I trade London. I always use the liquidity grab of the Asian session. This was where I got in on the buy up. It's the same thing. You got Asian session liquidity.
Right.
Price moves down, it grabs the liquidity and it moves out. Many of us who traded that that 100 pip joint, we got in a trade one night on the liquidity grab, and it's a very unpleasant feeling. That's how it works. That's kind of how that it's a liquidity grab because it's going to rush. Those candles are going to be some good thick candles, on that 15-minute time frame, and it's going to make your stomach, feel bad because you're like, man, like where is this thing going? Where is price going? And then ease up. But those should be your natural keys to trading, and you have to kind of understand that if you're going to trade the session. You got to understand coming out of the session, if you're biased for a long or a short, hey, what do I want to see? What is my draw on liquidity? Is it an imbalance? Are we going to take out these lows before we go higher? If you have that in mind and you're coming to the market with a plan, then you can enter that trade with confidence. Or you don't see the setup and you don't enter the trade. It's nothing wrong with coming to the market and saying, hey, I don't have my setup. It happens all the time. Does that make sense?
It does. I was gonna ask you too, when you put that the Asian range, the Nikko 948 joint on the indicator, does it only show up on certain time frames, or does it show up?
Yeah. So it naturally it's just gonna show up on the 15-minute. But if you go to the settings and you go to inputs and you click this show Asian session on the 1 hour chart, it'll show up on the 1 hour chart.
Gotcha. Okay. I see. Because every time you call out the Asian session liquidity grab, that's why I be wondering how you.
Yeah.
Okay. I see it. Nice.
Question.
So, I'm sorry. Go ahead.
I was looking at EJ and I'm using the Asian range, and I just wanted to see, like, based on what we're like discussing right now, you wouldn't have entered this trade because I don't see a wick.
Well,
as the Asian rate, or would you have entered?
Well, let's talk about it. Let's talk about it. What are your expectations of this trade?
I didn't look at it. I was just like going based on, because I'm in GJ, but I was looking at this and I'm like, I would have missed out on that trade because I didn't see a wick.
Okay, so
that
I'm
even
glad you
came.
said that. I'm glad you said that. So this trade, if you look at this, it came from here to here, and it pulled back, right?
Yeah.
Now, what if you use this high and it came from here to here, and now it came up and ran that high?
I get what you're saying.
It changes your impression. So here's my point. For all intents and purposes, this was your high, right?
Right.
This is your high. Are you tracking, for?
Mm-hmm.
Yeah.
All right, you get a pullback, then we run this high, and immediately you come and run this low. What does that mean?
I'm going lower.
That means you're going lower. That's a change of character. So it doesn't have to, you wouldn't have got in right here after the Asian session, because that's not where you're supposed to get in this situation. After you run this low, price is going to trade back up. That's where you're getting in the trade. You see that?
Yeah, you're still using, or you got to use everything that you know. Because I was just like,
Yes.
okay,
Yes.
on
So, okay,
the range.
you're exactly right. But for this particular case, in Asia session, you ran this high. So what you're thinking as a trader, everything changes. Like maybe before we ran this high, or maybe because we ran this high, you're thinking we're going to pull back and go higher.
Yeah.
Because I would have definitely, this is a push down. This is a pullback, a great pullback when we went lower. Then the market came back and ran this high. So now I'm like, hey man, this high shouldn't have been ran.
Right.
I'm thinking the market is going to go higher. It pulls back, it goes higher. So if it pulls back again, it shouldn't break this low. But it does.
Yeah.
So now maybe you're going lower. And maybe this was just inducement, right? And this was the intermediate high. But I personally was out on the JPYs after we got this huge run back up, because I need more information.
Yeah.
And I really haven't been trading EJ, but if I was trading EJ, I wouldn't have been looking to sell it because we broke this high. I would have been looking for it to come back and respect it. But then when we broke that low, now is the game on. Now I'm biased for the short, just like I am with GJ. I think they do need to pull back. Even if we're going higher, to me, we still need to pull back to a discount before we go higher. So I would fib from these lows down here to this high, and I would want them to pull back before they change directions.
Okay. So still an opportunity.
Yeah, but it looks different on this one because we had ran a high, and it did. That's why we didn't have to grab liquidity, because we just grabbed liquidity.
Okay. Thank you.
All right. All right, any questions? Hey, if y'all are ever in doubt, man, use the line chart, please. Use the line chart. The line chart ain't gonna lie to you like your homeboys and homegirls gonna lie to you. They're gonna lie to you. The line chart ain't gonna lie to you. And the concepts, man, I can't really stress this enough. You have to believe in the concepts that you're trading. I mean, it's why you are hunting your trade. You're hunting your trade based on a concept. It's impossible for you to trade and consistently make money if you don't believe in the concept. Do y'all get that?
Yes.
The concepts, if you know the concept, you have to believe in the concept, back test it. If you like the first time you hear about the concept, if you don't believe it, back test that joker. The only way you're ever going to make money is by hunting your trade based on whatever the concept is around your trade. You know, if I believe that liquidity needs to get taken, I'm not getting in a trade, you know, until I see that liquidity get taken. And if I do get in before the liquidity get grabbed, I have to be able to survive the liquidity grab. If I believe in the kill zone times, and I'm only looking for to enter my trades during those kill zone times, then you know I'm not entering a trade at 2 p.m. on New York session. So it depends on what you believe in. And then once you start seeing those concepts, you take your trades, you know, based on those concepts. So my question, I'm sorry, go ahead.
I just wanted to mention on this particular trade right here, EJ, because I trade EJ.
Mhm.
I thought faux meant earlier like the move up. And if you can stretch out your chart for a moment, please, I just want to point something out and make it taller too, please. Yeah, and go back down to the bottom. Yes. Okay, so no, the bottom. Right. As right there.
All right here.
Yes. Stretch it back. Yeah, like that. Perfect.
Mhm.
So I trade London session and I was looking to enter long, but I was also looking for like Asian session to be taken out. But you can see on the bottom that it wasn't taken out at that point, like on
I
where
know. But why wasn't it taken out, Elfie?
because it took liquidity from the inside.
Of course.
There's internal and liquidity, which I didn't. This is what I'm trying to point out, though. I didn't like have an eye for it to like also take Asian internal liquidity because it dipped into it right there where the H is. Can you see
Right.
that? Yeah, that one.
Yeah, exactly.
Yeah, it didn't occur to me like it just wasn't on my radar. And I just wanted to point out like it doesn't always have to like take out the bottom of Asia or the top. It can also be liquidity inside of Asia.
I agree. I agree.
Right. That's what I was asking, Elfie. Thank you.
Okay, because I was just like, that's exactly and I missed it right in front of my face.
Right. That's why I was like, oh, this wouldn't have been an opportunity, but it still is. So that's why I'm
Well,
like,
Right. Go back. So
look for that
like,
as
what the
well.
hell?
well,
Yeah.
hold on, y'all. I think y'all are well, I don't know if y'all are totally missing it, but I think you have okay. The market closed here, right? This was on a Friday, right?
Mhm.
Mhm.
The market gapped down. Here's where the market opened. We were biased for the buy of JPYs. Yes or
Right.
no?
Yeah.
Market trades up. It pulls back. Where is your entry for the buy going to be? At the freaking gap. At the gap.
The imbalance.
Okay. If your entry is at the gap, you got tapped in right here. Yes or no?
Yeah.
So we have to understand the concept, guys. I get it. This is a Asian session entry, one of those rare show ups of your entry, which is a JPY pair, is an Asian pair. This is a entry that happened on the Asian session. This pullback is your New York or your London session kill zone entry. It did take internal liquidity, but the point is your entry was at this imbalance, guys. Every session will probably give you an entry if the trade is going your direction. So this is your your London session entry. Then the price takes off. Why did we get a pullback right here?
Yeah, the imbalance.
That too, but this is New York. This is New York session.
Oh yeah, New York usually give you a
They're
continuation.
gonna give you an entry.
Yeah.
So understand that I get it. You're looking for the Asian session lows or highs to get taken every trade, but no, that's not really what you should look for. You should look for the market to come back to where it's supposed to come back to. You have to understand that, hey, the entry was an Asian session entry. This pullback is a London session entry. I didn't get the original entry.
Right.
Right.
And this entry took liquidity.
Mm-hmm.
Yeah.
You see what I'm saying?
Mm-hmm.
It tapped into the imbalance. Remember, I know we talk about consequent encroachment. Price does not have to go halfway through the imbalance. Even on that video we watched, some of those tap-ins closed the imbalance or went further than the imbalance. It didn't break the candle, but it went higher than that wick or lower than the wick. Some of them just touch the imbalance and roll. So you have to be equipped with all of the knowledge, so with all of the understanding, and look, hey man, we got an entry here. We took liquidity before that entry. I'm getting a pullback to get in. The same way I'm going to get a pullback to get in on New York. If you're up at 7 a.m. looking for your entry, there's your entry at 7 a.m. If you're up at 8, there's your 8. 9, there's your 9. They're all relative. It's the same entry.
Right.
So what I'm trying to say is you have to understand the goal, what needs to be accomplished on the chart. That's why I put this here. I was talking to somebody and I typed this here and I sent it. Look, this is where we want to buy from. That was after this market gap, then we pushed up. This is where we want to make our buy from. I don't trade EJ when I can trade GJ because GJ gives more money, in my opinion. But this was where I wanted to buy from because of that gap. And it came and hit it perfect. So that's why you don't get this. But if along those same lines, you're not always going to get a run of liquidity and price go the opposite direction. This took a while. We still ran the high and then price pushed down. In this one, we came up into the imbalance that was created on Asian session. We didn't run the high and price comes down. So y'all are correct, but you have to kind of understand what you want to see or what needs to be accomplished on the chart as a trader. You know what I'm saying?
Yeah.
Yes. I was just trying to point it out because, like I said, I wasn't looking.
Yeah, no, I appreciate it. I mean,
didn't
I
see
think these are conversations that need to be had because,
Clarity.
yeah, and many people will never see that, LV, until 2 or 3 years later. But so these are great conversations.
I have a question.
What's that?
I have a question. I think somebody else is trying to speak as well, so I don't know.
What's your question, Mike?
Oh, my question is, where would you consider the break of structure in this here? For me, I see the bottom, but I think at the top is where you guys mark it. Where your cursor is right now, is that the break of structure? That tip of the candle?
Bro, when price pushes up?
Yeah, there's a break of structure there?
Yeah.
Okay.
Why? What are you referencing?
No, because I'm trying to understand. Because sometimes, all right. So if you see where you place down a bit, where it says Japanese, the S right there is where I would usually consider as a break of structure. Yeah, that right there.
The market gap down though.
No, not where the gap is. Go up a bit, up a bit more. That line, yeah, there is where I will consider as a break of structure.
This is where your market structure shift happened. This is where your chalk happened. This push up, I would call that a market structure shift or a chalk. Then the market pulls back to give you an entry. But here's the issue. Here's the issue. This entry right here is just an inducement. You were induced.
Okay.
Because you were induced because this imbalance wasn't hit. And it's cool as long as your stop loss includes this imbalance. Because the market pushes up and pulls back and goes below your entry, it actually touches the imbalance.
Okay.
I mean, in this scenario, is not a lot of pips, so you probably wouldn't have gotten taken out the trade, right? But if you're a person that likes to use the air quotes, the sniper entry, and you want the 2 pip stop loss, maybe you would have got wicked out right here.
Yeah, no, basically what I'm trying to establish is where I should consider as a break of structure so I can see, okay, we might be turning around and going a different direction. So I was thinking maybe it's there where you marked or slightly above, but where
Well,
you marked, where I usually.
this is definitely your market structure shift.
Okay, perfect. All
And
right, thank
I think all of us were looking for longs, all of us except for Kim, were looking for longs uh coming out of going into that week.
you. Okay.
Lately the market it has a lot of gaps, for whatever reason. I've never seen so many gaps uh in these markets. But whenever you have a gap, you just have to treat that as a imbalance, right? Or
Mhm.
the
Why
market
isn't
push.
why isn't the shift or break lower than that at the end of that first green candle, the top of that first green candle?
But right here, because that was
How come that's not the shift?
because this was the high.
Oh, the swing high.
Yeah, especially on a lower time frame, that's definitely a swing. Like if you was down on that 2 minute chart with your boy ICT,
Mhm.
I mean, this is a great inducement, but I'm surprised this didn't go lower because of that. But it is what it is.
I went to the 50% of that imbalance.
It's all great. Spice Girl,
Yeah,
how you
so
doing,
it
Spice
did.
Girl? So how you doing, Spice Girl?
Don't talk to me.
Because I call you Spice Girl.
So, so Todd, when he talked about the power of three, we had looked at that on this EJ trade going up,
How would you have looked at it?
like using that concept of his power of three.
Well, I think that this whole thing is your consolidation or your accumulation, and maybe your dish or your manipulation was the fact. I guess this shoot down would be your manipulation. After you broke this high, to me that was the indication that you're going higher. Then you get the pullback. So this pullback might have been manipulation. Especially some of y'all probably thought this was a break of structure going to the downside.
So kind
I
of,
don't I don't see. I'm sorry. Go ahead.
I'm sorry, I didn't mean to interject, but um, in this case with the power of three, it never went below, like it didn't run below opening. Like only that one candle that gapped was the only thing that was like below open price.
The
Exactly.
gap with power of what the gap to me is the power of three.
Yeah,
Yeah.
I think some
Gap
people would
down,
take
didn't
this
tick
as a
down, gap down.
yeah. I think some people would consider this as a break of structure and be looking for lower. You got the break, you got the pullback, and some people are selling that. I don't really see a lot of dumb money entries anymore because my eyes are kind of trained for the smart money stuff. I don't really see a lot of the stuff that I was taught when I first started trading.
Hmm.
It's easier for me to see liquidity when I look at a chart than ever before.
And I think on the higher time frame, it actually tapped into, if you look to the left, I think it tapped into either like a weekly order block or something, tapped into something that, which is why it stopped further, or monthly or something.
There's a OB over here.
Yeah.
Yeah, this is gonna be Betty interesting. I don't like the way the JPYs didn't push further down. So, I'll be taking my boy down. I'll be taking my boys to the flow. Bing. All right, does anybody having problems? Anybody struggling? Y'all see these EU and GU buys setting up? Y'all believe we going higher and higher?
Can we look at gold,
uh,
please?
Gold. Sure, man. We can look at gold. We can look at ugly dad gold. What's your take on gold?
I haven't yet looked at it. I was just trying to see if you got something to say.
No, I mean, I don't really trade this. I would like to see it pull back though. You got that nasty double top. You got relative equal highs. I would like to see it come down to this level.
To where?
To this level. Below this wick.
Okay, I was looking at that wick too.
I mean, we'll see. Honestly, gold needs to really come and retest, this area down here. But I mean, that's a long drop. And the dollar's getting weaker. So gold should be running opposite the dollar. I mean, I guess they were kind of coupled for quite some time. But I think there's a little imbalance below this wick. There's imbalance below this wick. Hey, Gigi, is New Off on here?
Yeah.
Or what are you looking at for gold? I know you
Yeah.
trade this.
For it to sell. But gold is still bullish overall. So we gonna see. But
Yeah.
the market open, it should go down. That's my thinking.
So that means y'all should expect to buy and then
It should go up and then go down, yeah.
we shall see. Now for the last, I want to say, I thought it was going to sell a week ago.
That's what I'm saying. Go do what they want to do.
Yeah,
That's why you gotta.
I honestly thought that we were going to push down. I mean, if you look at this weekly, there's a reason.
That's a shooting star right there.
Balance right here.
Yep. 2 week, 3 week bullish. That's a shooting star. So probably. Yep.
2 week bullish. Yeah. So it should come down. I mean, there's another imbalance down here. I guess it will come back. You got to break a structure here. So it has to come back at some point. And this is where I would look for that bad boy to come back to.
Yep.
So, I don't know if it's coming down there now. That's 27.50 for Terry's quarters. Quite a little. Elfie, do you trade gold like that?
Every now and then I try. But I want gold and EJ to be my two friends.
I want to know if it's safe for me to get in this USD Mexican drop so I can get paid this swap fee. I got that quiddity grab. Y'all see that quiddity grab? And I've been talking about this trade for so long. It's starting to lose its luster. Hmm. Hmm. Hmm.
Mm-hmm.
I need to catch me a short from right here. But this, it gotta come on with it come on. It gotta stop playing.
What is it like trading that?
You said, what is it like?
Yeah.
I've only traded it one time. I traded it back
Oh.
in 2020. But the reason why I'm interested is because they're gonna pay you a swap fee. So you can just leave that trade running. You know what I'm saying?
Mm.
It's a trending pair for sure too. I met somebody like back in 2018. That's all she traded. She was like 65 years old. That's all she ever traded was USD Mexican.
Really?
Mm-hmm.
What does that mean? They pay your swap fee? Who is the
It's a carry trade.
It's a carry trade.
It's a carry trade. So because of the interest rates are higher on the Mexican peso, you get paid the swap fee because you're selling the dollar, buying the Mexican peso. So since you're holding the Mexican, you're getting paid the higher interest rate.
Okay.
So let's say this thing drops for the next 6 months. Every day you're going to get paid to hold this trade, and whenever they use, that's why the JPY.
Oh, that's for me then. That's for me.
Yeah, I mean,
Because I could hold it.
there you go. That's what I'm saying. And that's why the big dogs, they look for these trades because they got millions of dollars. And the way the guy explained on the video, they get paid for the money, but they also getting paid, they might get paid, $1 million or $100,000 a day holding this trade. 10 days, you're making $1 million. That's why those JPYs were buying like that, because the interest rates were great. And that was the carry trade. And that's why it unraveled. That's why they're not buying like that anymore, because the US lowered its interest rate and the Japanese raised its interest rate, which kind of throws off those guys who were in those positions for all those, those years pretty much. So they took their money and they ran. I would encourage everybody to go to YouTube and look up carry trade video, and they'll explain it to you. I know we've watched it, I think twice, but if you go and you look and you find the carry trade video, they'll explain that to you. Okay, so is anybody struggling? Anybody feel like they need help?
Of course. Only thing I'm trying to better understand, Ty, is just that power of three and the concept of how we're trading. That's probably the only thing I've been focused on this last week.
I encourage you to put that ICT 2022 mentorship on. Watch it and don't deviate. I'm trying that right there. He explains it throughout that video. He explains a lot of nuance, but that whole series is about the power of three.
Right. I'm on video 20.
Yeah.
right now.
So, hey, and have you understood what he's saying?
I do. So and that's where I don't say I get confused, but I know he's coming from an intraday concept and we're coming from a swing trading concept. So when he's talking about uh just kind of how he was explaining in the video, how if you get that gap and then you get that next candle that mitigates it. Um, I get that. See, I get that because I come from an intraday background.
Mm-hmm.
What's tougher for me to see is letting I guess it's called inducement, letting it drop all the way down and then come all the way back and waiting for that moment. That's the part where I'm trying to figure out how the power 3 works with the swing trading versus with the intraday trading. And I get it's fractal. It's just that's the part that I'm struggling with is seeing how it works with swing trading and not so much the intraday trading. I get the intraday trading because it happens pretty quick, but don't happen quick is when it happens with swing trading.
Okay. Let me try to.
I think you should go to a weekly candle.
You said a weekly.
Yeah, because that's what we normally trade. Like,
Okay. Here's a good example, I think. This is a weekly order block, right? And if I fib this order block, I want to see price come down into the zone, right?
Right.
Once it pulls into my zone, I'm interested in taking longs, all that good stuff. If I'm short, if I'm bearish on this candle, if I'm bearish, what should happen first?
It should open and
Go up.
go up first.
Where's it going to?
You said where's shit.
Closing the gap.
This high would be great, right?
Okay, I got you.
So if you're looking for price to move up on the weekly chart, let me make sure that let me highlight this.
It's because I thought if I did that and they gave you all, if I did that, whoa.
Okay, so what I want to see is for the price to come up and take out this weekly high, right? So if I look over here, there just so happens to be an imbalance right here, right?
Okay.
It would be great for me to see price go up to take out this high before it starts selling. The market gaps down. It opened with a gap, right? Then we go up and take out this high. You see that? Market gaps down, Asian session run. What happened? If you was going to go long, it takes out the liquidity. Then it pushes up right to where you thought it was going to. When you filled that fair value gap, then this New York open, kills on time. It gives you your entry to go short. You see that? You quiet. You quiet. You quiet.
No, I said, yeah, I get it.
Okay.
I did.
So it gapped down. Nothing like all this is a distraction. Nothing should change your mind, right? As a matter of fact, this gap down, you just feel this imbalance. That's all that happened here. You broke a high, right? You broke this high. See that? Market comes back, feels that imbalance. you run higher, right into the imbalance, you run the weekly high. Everything on this chart is still intact, right? Everything is everything. All the way down to this level. Where we broke this high and nobody came into this imbalance. Nobody. You see that?
Mhm.
So I guarantee you this price is coming to fill this imbalance. Every other high that got ran, price came down, filled the imbalance, ran high. Every other high, when this broke right here, price came back into that imbalance. Why didn't it come back into this imbalance? Broke this high, we came back into the imbalance. Now we filled that imbalance. The move up right here happened as a London session trade, right? This happened. This was a London session trade that you could have made. I don't know. What is that? I can't even see because this thing is in my way. 78 pips. Maybe you got 100 pips. But that move was there. Then the New York session kills on time for this USD, GBP USD pair, gives you your entry for the sale. Hopefully everybody sees that. You can't make this stuff up. And once you get your entry here, I would have targeted that low because it runs right into that imbalance. That's 167 pips. Okay, so obviously it hit, y'all see how it hit. You TP'd on the gap down, right? And it gapped way below that imbalance. So that was from 1 week to the next. It took a whole week for this trade to play out.
Can you reiterate like why we don't go to the 78? Because after the gap, we wicked into our 78 imbalance, but why isn't that the target? Like I know, but
Why would you don't know it's going there?
okay.
Is this bearish or bullish?
I'm sorry.
Is price bearish or bullish?
Bullish.
So why are you trying to sell it to the 78?
Got you. I just need a reiteration because I know I'm always going to my golden zone and looking for those
Right,
imbalances
which is
to
cool.
50. Right.
Yeah. So I want you to understand that sell trade part of this
It's
is just a
temporary.
pullback. Yeah. So don't get caught up because you'll get smashed.
Got you.
You got to take it to the first available point on the pullback. Now, if you're long on this, you can allow your price to extend.
Got you. And vice versa if we're bearish.
Yeah.
Okay. Thank you.
And this was the part where y'all lied to me and said that this was a bearish trade. Because from this point we went up and we ran that high. Y'all told me we didn't run it, but we ran it. Then we came back to this imbalance. And then we pushed a little bit further down to the imbalance on the news. Brett, stop lying to your boy.
So no lies this week.
Yeah, don't tell no lies, man. If it ain't on the line chart, don't lie and tell me it is. The line chart ain't gonna lie.
But the line chart lying too.
No, the line chart ain't lying. You show me where it lied.
It's lying.
Show me.
Line chart is lying.
There you go. I think we're making progress as individuals. If you trade like me, you got to see it like me. If you trade like Andrew, you got to see it like Andrew. You trade like Newell, you got to see it like Newell. GG, Kim, you cannot switch and think you're going to find success soon. It's only going to make your trading journey a little bit longer. And hey, there's nothing wrong with that either. If you want to have a longer trading journey, a longer journey to being successful, that's cool. But if you don't understand what I'm saying, then by all means, go find somebody who can explain it in a manner that you understand. Because every style isn't for everybody. But it's important that you give that style time, so you can actually understand it, and you need to spend time on the charts developing your eyesight and your understanding of the style that you're learning. And then you just back test and try to master those concepts that come along with the trading style. Because every system works if you are consistent. If you're consistent, every system will work. Support and resistance, it works. Oliver Velez, which is an OG, has made millions and millions of dollars trading elephant bars and all kinds of crazy stuff. It works. But
what is the elephant bar?
That's his stuff he made up. But he's consistent. He's disciplined enough to only take trades based on his system. And if you're a person who's that disciplined, you're only going to take trades based on the system that you're trading, you're probably going to win more than you're going to lose. And that's going to grow your account. That's to me, that's the beauty of trading. You can trade smart money, dumb money, even money, no money. As long as you're consistent, you're able to turn a profit. You can trade indices, you can trade gold, you can trade one market, you can trade all of them. It all works if you're consistent. And I want everybody to find their level of success, right? Their what works for them. And once you find it, you got to hold on to that with white knuckles. Don't get knocked off your game, if you're successful trading, the 30-minute chart with Newell, you hold on to that 30-minute chart. Then when I start talking, you turn off Zoom. Because you're going to get confused if you're listening to everybody's information. I'm not going to talk to you about supply zones and demand zones. I'm going to talk to you about order blocks and imbalances. I'm not going to talk to you about flat levels and whatnot. I'm going to talk to you the way I talk to you. If you're talking to Andrew, he's going to give you the flats. He's going to give you the internal, external liquidity. You have to be disciplined enough to focus in on what that person is trying to show you, right? He or she is trying to show you things that work consistently in their trading style. And if you can emulate those things and you can be disciplined enough to only take those trades, you're going to make money. It's all about the consistency. It's all about the discipline, self-discipline. But if y'all treat y'all's trades like y'all treat y'all's relationships with y'all's guys or y'all's boyfriends or girlfriends or husbands or wives, then y'all in trouble. Because it ain't gonna work. Right. Any questions? Back testing is your friend. Do a lot of it.